Another very strong month for equity markets.
Approaching 94% of the economies in the world are now in recession or approaching recession.
The sharpest economic contraction since the Great Depression.
And we've got more zombie companies than ever.
Every dollar that has been created is generating less and less GDP. There's so much money out there looking for a home that it just continues to drive global equity prices higher.
We're going to talk a lot about it, so welcome, and let's dive into the market review and outlook for the month of July.
Another very strong month for equity markets, not just in the US where the S&P 500 up over 5%, now up 46% since the market bottom in March, but then even stronger overseas, emerging markets, foreign developed markets, very strong performance.
The narrative continues of the economy and the market diverging significantly. We're at a point of sort of historic relevance in terms of the number of economies in the world that are in a recession. That number is approaching 94% of the economies in the world are now in recession or approaching recession. Let's walk through some of the reasons why this is happening and what our outlook is with respect to where the S&P is headed from here.
Yeah, just on the economic side. So once again, the economic catastrophe here is unprecedented, and it's not just in the US, it is global. So, over 90% of economies currently in recession across the globe. That is a record, data going back to the 1870s. And then also in the US during Q2, the first estimate for Q2 GDP fell at a 33% annualized rate. So to put that into perspective, that is the sharpest economic contraction since the Great Depression. If we were to repeat the Great Depression, then you would basically need 3 more quarters just like Q2 in the US. So this has been extremely sharp and hopefully will be extremely brief. And, a lot of that just hasn't mattered because the expectations have been so low. The economic data in the US has been coming in better than expected, actually. If you look at retail sales, if you look at housing data, if you look at personal income data, all these figures are coming in better than expected. And a lot of Americans are spending as if nothing ever happened. So this divergence is increasingly being created because of a divergence between economic activity, which is really bad, and the amount of money in the global economy, which is absolutely off the charts, a new record, the amount of money that's floating around out there.
Walk us through sort of globally what's happening in terms of the money supply.
Yeah, globally, if you start out and you think about central bank assets, right now, central bank assets globally are expanding at about a 25% year over year growth rate, which is huge. We've been during 2018, 2019, the economic outlook was far better than it is now, but we were a little more bearish than we are now. And the reason is because now there's 25% growth in central bank assets, and in 2018 and 2019, central bank assets were shrinking. And that's just been totally unprecedented. And the U.S., the Fed has been leading the way. The Fed has increased their balance sheet by over $4 trillion. So if we think about the hierarchy of money, you can start there. You can start with central bank assets. And then those central bank purchases of assets flow into commercial bank balance sheets. And that's where we start to get into the monetary base. And then from there, you get broader measures of money that include consumer money. So money in consumer checking accounts, savings accounts, certificates of deposit, all those types of money, that's measured by M2. M2 growth is at an all-time high. M2 is growing at over 20% year over year rate. And once again, not just in the US, it's growing at extremely fast rates in Europe, in Japan, and even in China. So the monetary response to this crisis is almost equal and opposite the economic catastrophe.
Explain M2 and what it really is, what it means, and then compare and contrast that to sort of the velocity of money and what gets spent on goods and services and what happens when there's no spending, which is, I think, the case we're seeing.
Yeah. What you're seeing is when consumers have money, they basically have a choice. What am I going to do with this money? I can either buy goods and services. If they do that, then every dollar they spend counts towards GDP. We know that that's not happening, clearly, because Q2 GDP was down 33% annualized in the US. So where is the money going? And that's this chart where we look at the monetary base, which is another level of money, versus the velocity of money, and these lines moving in completely opposite directions, shows what's going on here. So you have more money, the monetary base rising rapidly, M2 rising rapidly, but every dollar that has been created is generating less and less GDP. So it's being used for other things, or it's not being used at all. And that's the velocity of money. The velocity of money is how many dollars of GDP are created from every dollar of money supply. And it's almost 1-to-1 right now. So that is an all-time low. That it's never been that low. So if all that money is being created and it's not being spent, it's going to go somewhere. It's going to sit in a checking account, sit in a money market account, or it's going to flow into financial assets, which is what has been happening.
And let's sort of take that point a little further. So the money that's sitting in money market accounts, we're seeing a large amount of money. We call it sitting on the sidelines.
There's so much money on the sidelines that if that money just starts to bleed into the market, this rally can just continue in equities. And so if you look at just money market assets, so the amount of money held in retail and commercial money market funds, think about at a Schwab or an E-Trade or TD Ameritrade, wherever, and you take that as a percentage of the size of the equity market, it's still at 16%, which is extremely high. In 2018, we were running somewhere near 11%. So just the money market that's sitting in an investment account earning 0%, if some of that were to start to bleed into the equity market, you could easily get pushed 4 or 5% higher just from that. Mm-hmm. And that's not taking into account the fact that during this entire rebound, you've actually seen money net coming out of equity funds and going into bond funds. And once again, if you're in high quality bond funds, you're not earning much of anything. We view those really as future equity flows in most instances. So you have money sitting in short-term bond funds that, how long is that money going to sit there if the FOMO continues to build and interest rates continue to be at historically low rates? How long can that money sit in the bond market? And so if that starts to flow, if the flows change and start to go more in equity's favor, that's how this thing can just continue to feed on itself.
So give us your perspective on why you think this is happening. Why is money sitting in the money market funds, and whose money? Is this institutional investors? Is this retail investors, hedge funds?
So if you think about those different players, there's a lot of money in retail money market accounts, and that typically happens because retail investors historically are late to the party. So they raised a lot of cash during the COVID-19 drawdown, and they're usually the last ones to get back in. Institutional money, money was raised during the COVID-19 drawdown primarily because there were concerns about, one, don't want to experience equity losses, but two, I might need this money to operate the very difficult business environment. So let's keep some cash on hand. What then subsequently happened was basically every corporation that wanted to borrow money after the Fed stepped in could do it at extremely low interest rates. So a lot of that cash that was raised ultimately will not be needed because you were able to raise debt capital at very low rates. So some of that money has started to go back in. And then you think about hedge fund money. A lot of hedge fund money that got raised during the COVID-19 drawdown was simply because volatility and risk picked up. A lot of hedge funds determine how much exposure they have to the market based on trailing and future estimates of volatility. So when volatility spikes, just mathematically, they reduce their exposure to equities and other risky assets, and they raise cash. And so now as volatility has started to fall and normalize, more and more hedge fund money on the sideline has started to come back into the market. It's very systematic and formulaic. It's part of their risk management processes. And so at first, that money came into the bond market because bond market volatility fell much quicker than equity market volatility. But now equity market volatility is falling as well. And so now that's going to be an opportunity for a lot of these hedge funds to add to their equity exposure. So if you put together the ecosystem different players and you look at the technicals and the flows, you can see these are actually net very bullish from here.
Let's shift gears a little bit and look at sort of the U.S. economy. We've seen a significant increase in the amount of corporate lending or corporate borrowing, and we've seen a significant rise in what we call the zombie companies.
So how very sharp economic contractions typically work is, they start in the economy, and then the credit market is the link between what's happening in the economy and what ultimately happens to the stock market. But what happened this time around was the Fed severed that link. So typically, economy goes poorly, earnings get ugly. Companies find it very difficult to repay their debt. Their borrowing costs go up. They can't issue new debt. And then as a result, they become less of a going concern. Their equity sells off. The link is the credit markets. The Fed this time around, through, for the first time ever, buying corporate bonds, effectively severed that link. And so what we've seen now, normally, when you have an economic collapse like this, corporate debt to GDP goes down quite a bit because corporations default on their debt, or they think they need to shore up their balance sheet, become more conservative, they pay down debt, all these things. They get in a better place, more secure financially. That has not happened yet. In fact, the opposite has happened. So corporate debt to GDP it was at an all-time high coming into this crisis, and now it's almost 50% of GDP, corporate debt. And you've seen record new issuance of corporate debt this year. So nobody's thinking about paying down debt. They're thinking about taking on more debt, which typically that option just isn't available when the economy is this bad.
Mm-hmm. And so the other question we get a lot about is the impact of bankruptcies, or what impact bankruptcies will have on the economy as we go forward. And surprisingly, or not surprisingly, I guess, from our perspective, we haven't seen the bankruptcies tick up yet. Mm-hmm. We do expect them to, but they look kind of normal. So give us the perspective on what we're seeing and what we expect on the bankruptcy side.
Yeah, and once again, in a normal economic crisis, you have the best term for it is what's called creative destruction. So you have a lot of weaker players that just haven't been good allocators or investors of capital, weak balance sheets, and they end up filing for bankruptcy. They get wiped out, and that capital is absorbed by stronger players. And so then, that was a difficult crisis, but we feel stronger coming out of it. We're on a firmer footing. And, that hasn't happened yet at all. So Chapter 11 filings, total Chapter 11 filings, we haven't seen a huge pickup. Doesn't mean it's not coming. Hasn't happened right now because of how effective all this emergency fiscal and monetary stimulus has been. But as the focus shifts down the line, 2-3 years down the line, and this might be dependent on who's in the White House, or who's in the House and who's in the Senate, as the focus shifts to, okay, how do we as a country start paying back our debts, and the tide goes out and this big flow of money recedes, that might be when you start to see Chapter 11 filings.
Yeah, but just like thinking about like what we're seeing right now, the number of companies that can't even cover their interest payments with their earnings, it's already a third of the index.
Yep. Yeah, right now over 900 companies that are in the Russell 3000 index, so almost a third, aren't generating enough earnings to cover the interest payments on their debt. Yeah. Not even talking about paying back the principal, just the interest payments. Right. So you look at those as future bankruptcies.
Yeah, just think it's like on the personal side, if you don't make enough money to just pay the interest on your credit card bills and your mortgage, that's what these companies, they can't even cover that.
Yeah, you need a Fed bailout.
Yeah, you need a bailout, right? Yeah. And all these companies are going to have to be bailed out or go bankrupt. So what impact will this have, these zombie companies have, if they don't go bankrupt, if they're just allowed to continue to refinance? And we talk about that, the allocation of capital and the healthy allocation of capital.
Yeah, if there ultimately is no creative destruction in this cycle, and these companies just continue hanging on by a thread and just rolling over their debt, then what you do is you just take all your long-term economic growth and earnings growth projections for the U.S. and you just bring them down, because our potential growth just won't be as high if all of these inefficient allocators of capital and weak players stay in the game. So it's going to be okay. We came out of this crisis, the stock market's back at all-time highs, but this is a very soggy economy and soggy corporate landscape. There's a lot of weakness.
Mike, it'd be really important for us to hit on this chart on sort of the fiscal stimulus impact and how we see it playing out for the rest of the year with respect to personal income.
Mm-hmm. Yeah, the personal income numbers have been off the charts, which, once again, going back to the economic damage is almost unprecedented, but the amount of money being created is also almost unprecedented. So personal income numbers month over month in April were a record month over month increase, even though the unemployment rate shot up to 14.7%. Those two things typically don't happen at the same time. Personal income was very strong in May and very strong in June. So due to the back payment of delayed expanded unemployment benefits in many states, just the expanded unemployment benefits, as well as the economic impact payments, what's basically happened is the average consumer has received a windfall of income in April, May, and June, regardless of their employment status. And the consumer behavior just gets into consumer behavior. They could either spend all of that as they get it, in which case, they're going to have to tighten their belts later on in the year. Or if they were to ration that, basically what we've calculated is the windfall that they've gotten in these last 3 months, that can easily be spread out over the rest of the year to actually maintain the average personal income from March. You knew there was going to be a huge income hole that needed to be plugged, right? And Congress did it. They plugged the entire hole and some.
And they're debating plugging some more of it right now.
Yes.
And so July's over, Mike, and the summer season is sort of drawing to a close, and we're entering the political season. The election is less than 100 days away. We're now going to start hearing a lot about what the direction of the country is going to be, and this is a very important time. So we're actually going to be shooting a separate video just on the research we've done with respect to the election, and we're looking forward to sharing that with the viewers. Do you want to give us a quick preview of that?
Yeah, part one is, we've spent a lot of time looking at historically reliable predictors of the outcome of the election, and we're within that window where they become very reliable. So part one, we're going to try to predict the most likely outcome at this point, given the information. And then part two, we're going to talk about, what are the near-term and long-term economic and market implications of that most likely outcome.
Great. Yeah, looking forward to it. So until then, have a great day and enjoy the rest of your summer.